Okay, want to know a crypto investing strategy used by the pros? All right, let's talk about dollar cost averaging. Now, you'll all know about buying the dip and the dangers of FOMOing in and the risks of getting wrecked associated with it. However, for those who truly believe in the long-term success of cryptocurrencies and pack the hardest of diamond hands, there's always DCA. Dollar cost averaging is an investment strategy geared towards mitigating the short-term price volatility of an asset. It could be a cryptocurrency like BTC or ETH, or even Doge, lovely Doge. Or it could be any other asset class, equities, commodities, you name it, that often show short-term price fluctuations. Now, we all know to buy low and sell high, but actually doing so is an art that few have mastered. Perfectly timing the market is practically impossible, especially for the retail investor. So, dollar cost averaging consists of making entries of a given amount into an asset at regular intervals over a given period of time. Crucially, these purchases take place regardless of where the current asset price is sitting. So, example time. It's March 2021. You've been doing your research and decided that ETH is a great asset that's likely to experience strong gains over the long term. Consequently, you've decided to dollar cost average with a fixed sum into Ethereum on the first day of each month for the coming year. That is from March 2021 to March 2022. Now, your investment in November would have been made at near all-time highs around the $4,400 mark. Similarly, your allocation for the start of December would have been made at prices of around $4,600. Now, if you had made your entire investment for the year at either of these points, perhaps because Ethereum was pumping hard at the time and you wrongly expected it to continue, or perhaps you were caught in the icy grip of FOMO, you would by now be operating at a loss. Indeed, at the time of filming, you would have lost nearly half of your investment. However, as you DCA'd throughout the year, your allocations for April, July, and August would have been made at prices of around $1,900, $2,100, and $2,500 respectively. Effectively, these positions entered at much lower prices would have mitigated the poor entry points experienced during the late year pump. Your low entry points have therefore offset your higher ones. So, the price volatility for Ethereum over the last 12 months would have been suppressed by the emotionless Terminator-esque investment strategy used as a result of your long-term belief in the asset. Your lower entry points in some months would average out with your higher entry points in others to provide returns that are not as strong as if you had invested everything at yearly lows, but much better than if you had FOMO'd in at highs. Now, naturally, your investment would have performed better if you'd invested all of your money on, say, 25th of March 2021, when ETH was below the $1,600 mark. But it's not just dollar cost averaging's ability to mitigate volatility that could make it an appealing strategy. DCAing doesn't take long. While day traders will spend their lives watching price charts and looking at the news, the dollar cost averager can spend their saved time researching alternative assets or even just, enjoying life. And what's more, deciding in advance exactly when you will buy and how much you will invest, you're able to effectively remove emotion from your strategy. And as we know, emotion can be a dangerous thing when it comes to cryptocurrency investing, especially if your hands are weak. But it's not just dollar cost averaging's ability to mitigate volatility that could make it an appealing strategy. DCAing doesn't take long. While day traders will spend their lives watching price charts and looking at the news, the dollar cost averager can spend their saved time researching alternative assets or even just, enjoying life. And what's more, deciding in advance exactly when you will buy and how much you will invest, you're able to effectively remove emotion from your strategy. And as we know, emotion can be a dangerous thing when it comes to cryptocurrency investing, especially if your hands are weak. Now, there are some downsides to DCA. The first and most obvious is that if you could time the market perfectly, you'd get more bang for your buck. However, as we know, this is a very difficult thing to do. And what's more, committing to invest in an asset for a long period of time requires faith in that asset's underlying value. Your research and due diligence should be intense and rigorous enough to provide a high degree of confidence in the long-term performance. And finally, the discipline involved in dollar cost averaging is no small ask. There may be times when the cryptocurrency in question is looking shaky, with FUD flying all over the place. Conversely, said asset might reach crazy prices at which you feel uncomfortable buying in. So, the dollar cost averager must overcome these emotional factors and remain disciplined in their investment plan. In sum, dollar cost averaging is a widely respected trading strategy, and if you have long-term belief in a particular crypto, limited time to spend on research, and a desire to mitigate some of cryptocurrency's famous volatility, then hey, DCA could be for you.